Hello and welcome everyone to this latest weekly market recap for the week ending Wednesday, February. I think I'm getting my months mixed up. Let's try Wednesday, April 16th, 2025. I'm Tom Bowley, Chief Market Strategist at EarningsBeats.com. It's a pleasure to be with you again. Another day of insanity in the stock market. We'll talk about that in just a minute. Do want to just remind you that this show is covering action from the beginning of the day, Thursday last week through today's close, which is a little unusual when you're looking at weekly activity. It's usually the calendar week, Monday through Friday, but I just want to make sure everyone understands that's what we're looking at when we look at the weekly, indices, the weekly sector performance, and so forth. Another crazy day today. Right in the center of it, once again, is Fed Chief Powell. I've talked about this many times. Honestly, he had a discussion today. I think it was in Chicago, and he basically said the same thing he's been saying, which is, and I'm going to do a little paraphrasing here, but he basically talked about the fact that the Fed has two mandates, and they're really confused as to which one at this point they really should be attacking. So therefore, they're not really attacking any of them. They're just going to sit on pause as far as rates go, and they're trying to figure out with the tariffs, is there going to be, inflation issues? Are we going to see a rise in inflation? And with the economy, should we be worrying about the economy? Should the Fed be cutting? And so they're kind of in the middle. And he mentioned at one point that if inflation goes up and the economy goes down, that leaves them in a bind. And through all that discussion, the market just absolutely started selling off again. So we can blame the Fed a little bit for the selling today, but I'm gonna maybe just pause and leave the Fed alone today, which is a rare thing. And I'm going to focus more on market makers and the fact that, in my opinion, they are really manipulating you and me. They are manipulating the retail trader. As soon as that speech began at 1:30 today by Fed Chief Powell, the market started selling off, and it was like, what happened to the buyers? Well, market makers provide liquidity. If the market is truly selling off, everyone, we're starting to see some selling. Market makers should be picking up shares, but they weren't. It was like, again, they'd gone on a little brief vacation for the next 2 hours from 1:30 Eastern until 3:30 Eastern. We saw nothing but selling. It was just straight down, looked really ugly. And then last 30 minutes, a miracle happened. We saw market makers all of a sudden decide it was time to buy, and a lot of buying going into the close. And we saw a nice little rally back essentially to where we were at 1:30. So all that selling that took place, we came right back up in the last 30 minutes, right back to where we were, like nothing had ever happened, except market makers were able to line their pockets with some cheaper shares. And that's what they continue to do and what they've been doing, in my opinion, for the past couple of weeks. Since we broke down below 5,500 on the S&P 500, I've got evidence, at least in my mind, that market makers are using this weakness, mostly gap downs. We did have a gap down this morning, but mostly gap downs and early morning selling. Today was a little bit different, but again, we had Fed Chief Powell speaking at 1:30. So in my opinion, they took advantage of that, drove the market back to the downside by not providing liquidity, and then we saw a rally into the close. You are free to criticize me. You're free to disagree with me. That's fine. I'm going to stick with my opinion. I've seen it before. Saw it back in 2022. We're going to talk about a little bit more about manipulation later in the show. But for now, let's just leave it at that. Let's take a look at what happened over the course of the last week. The Dow Jones Industrial Average dropped 2.3%. Russell 2000 down 2.5%. S&P 400 mid cap down 2.75%. S&P 500 down over 3.3%. NASDAQ down almost 4.2%. And then, we should be giving an award to transportation stocks. I don't know how they can keep leading every week to the downside, but they did it again, dropping almost 5.7% over the course of the last 5 trading days. So not a good week once again for the transports. Moving on to the sectors. Now, most of what you're going to see at the top here, defensive groups. Most of what you're going to see at the bottom, aggressive groups. But remember, overall, over the last 5 days, the market went down. So normally that's what we're going to see. We're going to see many of the aggressive areas take it on the chin. So I'm not really reading too much into that. I think if the market were to rebound again and try to threaten a breakout, and on that move to the upside, there was a lot of rotation into defensive groups, and the aggressive groups lagged during that kind of rally attempt, that would be a problem. I don't see it as much when the market's coming down because this is typical market behavior. When the market goes down, defensive groups tend to do better than aggressive groups. So I don't really see a whole lot there in terms of sector performance that makes me think one thing, versus the other. It's just again, it's not been a great last 5 days. We've had our ups and downs, but overall we've been down, and you can see that was led mostly by the aggressive areas. Let's move on to the S&P 500. This is a chart that I've been showing our members and have been showing most of my YouTube shows and so forth. I think we're in a wide trading range right now. And with the volatility index as high as it is, it was back up into the mid 30s again today, or at least for a little while as the sell-off reached the bottom at 3:30 this afternoon. But when you've got a wide trading range and you've got high volatility, a high VIX, anything goes in this trading range. I can't tell you from day to day where we're going to be in this range. I mean, we could have days where we got the Dow Jones in the morning up 300 points. Later in the day, it might be down 1,200, and then we might come back, finish near break even, or anything goes because we are in this wide range. But this is what I'd be watching for in the S&P 500. The breakdown on the S&P was below the mid-March low at 55.21. That was the low close. We bounced off of that, got back up right about to the 20-day. We went a little bit above it, but I always say price resistance is more important to me than the 20-day moving average. And we had gap support here at 57.82. We had this open at 57.82. And so when we broke down, that prior support at 57.82 becomes resistance. And so 57.82 was resistance. Intraday, we got to 57.86. Never closed above 57.82 and then right back down. And if you've been watching the show here for the last month or so, 57.82 was a number that I was talking about for a while until we lost support at 55.21. To me, that now is the key resistance level, price resistance. So 55.21 to the upside, you can see failures just below that 55.21 level. Also, you can see them at the 20-day moving average. So the combination of the 20-day moving average, which continues to be in decline, and that price resistance level at 55.21, that's all you need to know to the upside. If we get up there, if you're bearish, that's where I'd be initiating short positions, because if you break out, you can get out fairly quickly with not a whole lot of damage. I don't like shorting because when this whole thing started, I really thought we were just going to have some sort of correction. I was thinking maybe 10, 12%, something like that. This is obviously morphed into more than that. But I don't know that we're going to, in my opinion, I don't believe we go back down below where we were. I think we got to a low of 48.35. The prior high back in 2022 at the beginning of the year, before we had that cyclical bear market, the intraday high was 48.19. I think the closing high was somewhere around 4,800. I don't remember exactly what that number was. But that was a key resistance level. When we took that out, that becomes major support. And we just about tested that a week and a half to 2 weeks ago when we got down to 48.35. So I'm kind of looking at that 4,800 level as being the key support and 55.21 being resistance. That is over 700 S&P 500 points. That's a lot. A lot of times trading ranges can be maybe 100 points. Maybe they're 150, maybe they're only 50. But to have a trading range that is 700 points with a volatility index in the 30s, you better put your crash helmet on. Just be ready for these big moves potentially back and forth. I could throw in one other support level, and that is after the tariffs were rolled back with that 90-day pause. That's when we had this huge rally. Since then, the low on the S&P was just above 5,100. Today, we got down to 5,220. So I would be looking at that low, maybe around 5,110, 5,120, something like that, in that range. That would be a short-term support level. But if that goes potentially we could go back to 4,800. I don't think we will, just my opinion based on everything else I'm seeing, but I think that isn't a possibility still. With the VIX as high as it is, I can't guarantee what's going to happen with the market short term, but that's the range that I would follow. QQQ, let's talk about it from the same angle. The breakdown, the rally, you can see the support mid-March at about 468. We did have a little bit of movement below and then right back up. We didn't have a close below that 468 level until we had the big gap downs to open April, where we went all the way down to below 410. I think the low came in probably somewhere around 402, 403, something like that. And then we rallied back. We had that 10% move back to the upside, maybe it was 11%. That was the second biggest day ever on the NASDAQ. And since then, we pulled back to about 430, 432 level. Yeah, that's where I put in a little green support level. We'll watch that to the downside. But clearly resistance at 468 could not get through. We have been struggling to get through the 20-day moving average. So again, just like the S&P 500, I think the NASDAQ 100 or the QQQ, we should be looking at the same thing. 20-day EMA and right up about 468 on the QQQ. That's an area that I think we need to really focus on. If we get through those two levels on the S&P 500, the QQQ, it doesn't guarantee us that we don't go back down to new lows, but in my opinion, the odds really increase at that point that we are not going to break below the low that we saw on April 7th. So that's from a bullish perspective if we can get through. Still got a lot of work to do, especially after the pullback that we saw today. All right, moving on. So I've talked a lot about manipulation, and I wanted to visually show you what I'm talking about here. And it really started as we tried to make our final move up the beginning of 2025. At the end of January, that's when I started getting very bearish, or at least very cautious. I wouldn't say bearish, I'd say more cautious. I said at the beginning of the year, I thought we were in position to potentially see a 10% correction. Well, we got twice that. We went down just a little over 20%, and we reached a cyclical bear market. But there were a lot of signs back in January and February. In February, as we made this last run up to this high, that was when money was rotating and defensive areas were leading. And we were already starting to fall on a relative basis in areas like technology and consumer discretionary. So the rotation was a really big factor in me being very cautious, but manipulation was another factor. As we made this run through the early part of 2025, we gapped up through this period, I think it was like the first 23 calendar days from January 2nd to January 23rd. The net gaps on all of those days, if we added up the gap ups and netted them with the gap downs during those 3 weeks, the net gaps were up $32. And the rest of the day, from 9:30 in the morning until 4 o'clock, we actually went down $10. So the net in this period was we went up $22, but most of it was gaps. It was not buying during the day. Then we get into this next period, and you see the gaps were going down, and the rest of the day was coming up. But remember, it was not coming up because of technology and discretionary. It was coming up because of defensive groups. So all of that buying coming back to the upside. Anybody paying attention to the S&P 500 is looking at it and just saying, hey, we got a new all-time high. Everything's great. If they don't look under the surface, you're going to say, hey, we're at an all-time high. This is perfect. Now we're going to keep going up. Well, if you know how to read the market, again, if you have some under the surface signals that you follow, you would realize that that last move up was exactly like the last move up at the end of 2021 and early 2022. Money rotated completely towards defense, away from aggressive stocks. And that is when I said, hey, we got some serious problems. I was in cash. And this first big red day right here, February 21st, that was the day that the discretionary stocks from 9:30 to 4 o'clock went down about 4%. And the staples, the XLP, during that same time went up 2%. So the difference between staples and discretionary was like 6%. And since 2009, there have only been 10 days that have seen anything, well, anything above, I think, 4%. The difference between what happened in discretionary during the trading day versus staples during the trading day, ignoring gaps. How did they trade during the day? Lots of selling in the discretionary, lots of buying in staples. 10 times that it had happened where we saw disparity of more than 4%. Going into February 21st, the previous 9 times occurred during either bear markets. 8 of those 9 were during bear markets. 1 was during a correction. So when that happens, it is never a good sign. And I wrote an article at Stockcharts that day and I said the top is confirmed. And that's what I talked about. And look at where we went. I mean, we just continued to sell off. So during this period, which I show highlighted in red, we just saw distribution during the entire period. Gaps were only down $4. But look at the rest of the day. We went down $67 intraday. That is just pure selling almost all day long. And then we get into a period where I'm starting to see some manipulation start to take place right here. We went from basically, we went sideways for 3 weeks, maybe 2.5 weeks. And during this period, gaps, we went down $17. Rest of the day, we went up $25. So we were actually up $8 or 7 and change during this period, but it was mostly gap downs and morning selling followed by rest of day buying. And as we go into this last period, and I just updated this through today's close, the gaps since April 2nd close. So since the last high where we really started to see the selling and the recovery and then the selling again today, during this period, we have seen gaps of $43 to the downside. Opening bell, just add them all up during this period. And we've had gaps totaling $43 to the downside on the QQQ. During the day, during all of this weakness, we've seen the rest of the day go up $11.50. So you tell me who's buying. It's not you and me. Well, I did buy. I'm back in the market 100% because I believe the risk of being in cash right now is greater than the risk of being in the market. I think the market's going higher. Again, in this trading range, I can't tell you from day to day. If we can get back to 4,900 or 5,000, then yeah, I'll kick myself that I didn't wait for that to get back in. But I had already bought some earlier, and I did get in at some of those lows. This was just filling out my position, which I did last Thursday. But anyway, I'm seeing manipulation. I believe the market's going higher. Again, could we go back down to the recent lows? Yes. I mean, could we go lower? Of course we can. I can't guarantee you we're not going to go lower. I'm just telling you what I'm seeing. I'm seeing in the market a lot of manipulation. I'm seeing a lot of sentiment that tells me the market's going up. And so that's what I'm going to stick with. Now, as you look at these gaps, minus 43 for this period and the rest of the day up 11, I'm just going to flip over to an Excel spreadsheet that this is a spreadsheet that's available to all of our annual members at earningsbeats.com. And you can see here was the period from April 3rd to today's, April 16th. There is your net gaps. And what that is, it's a formula, just adding the sum from H66 to H75 on the spreadsheet, which is from April 3rd to April 16th. It's basically adding all of this up right here. If you add up the gap downs and the gap ups, here was a gap up, $14. Here was a gap up, $10. They don't all go down. But if you add up during this period, add those up, it comes up to $43 net gap downs. And if you add up all the rest of these periods right in here from on April 3rd or from April 3rd through April 16th, I've got it broken down from action from 9:30 to 10, 10 to 11, 11 to 2, and 2 to 4. And if you add up all of those right there, which essentially is all of these right here, that is going to give you that $11.48 if you net those across. So again, most of the selling is at the opening bell. And then up until 11 o'clock, you have a little bit of gains, a little bit of losses. But after 11 o'clock, the net has been, like I said, going up those $11. So we're seeing afternoon buying. That is exactly what we saw back in 2022. So we go back over here, 2022. Let me show you that chart. If you've been following me for a few years, you remember these charts because this is one of the reasons I called the bottom back in June because of the manipulation that was taking place. But here was the distribution back then. That was from beginning of the year through the middle of May. If you look at all this move to the downside and you add up the gaps, this I broke down by different time frames, but I could have said the gaps minus 29 and then just added the rest of this together, which would have been about $82 or $83 rest of the day. So it's just all I'm pointing out is that selling not only occurred at the open, but it was selling all day long throughout this period. In this period, the gaps were minus 55. So market makers still gapping things lower, getting folks to panic and sell. And then the balance of the day. Look at this from 11 a.m. to 4 p.m. during this period. We went up $96. And then, of course, that's when we had that was the more pain ahead speech by Fed Chief Powell from Jackson Hole, Wyoming. And then that's when we saw one more move to the downside, slightly lower low. And then we had more bullish manipulation into the end of the year, where the only selling we saw during this period, even though we were mostly flat, the only selling was from 9:30 to 10 in the morning. Afternoon, again, we saw buying coming in. So now I look at the current period and I'm kind of doing the same thing, but you can see that the gaps, we're getting gap downs, but now all of a sudden the rest of the day we're seeing buying just like we saw back then. What happened after that? Market rallied strongly in 2023. So I think eventually once we get to at some point, I don't know what that point is, but it's going to start to get confirmed if we go through 55.21 on the S&P 500. I believe we're being manipulated to the downside, and I think ultimately we go back higher because of it. But if you look at this, and this low right here back in 2022, that was on June 16th. I want you to take a look at this. I'm calling the bottom in the S&P 500, June 16th, 2022. Be interesting to go back and take a look at that video. I'm sure I talked about the manipulation that was taking place in the market at that time. So make sure you check that out. Next thing I wanted to point out was just on our homepage, earningsbeats.com. You can sign up for our free newsletter right here. Easy name, email address, no credit card required. We got tens of thousands of folks that have joined us on our free newsletter, so feel free to do that. But I really, if you look on your screen now, we have a QR code that you can scan with your phone. We're going to have a special event on Saturday morning talking about this bear market in 2025. Is it noise or is it reality? In other words, are we going to keep going down or are we just getting a lot of noise in the market right now before we go back up? So this is going to be a really hot topic, especially given, what we saw today with more selling kicking in. You don't want to miss this event. So make sure that you scan that QR code and come over and join us at EarningsBeats and sign up for that event on Saturday morning. Even if you can't make it, we'll send you the recording. So make sure you register so you can at least get the recording. Also in the description of the video today, when it's posted, you can come right into the description and there will be a link that'll take you to the page where you can sign up for the event. So make sure you do that. Last chart I want to show you before we wrap up. This was a chart, or this was a report that came out last Friday. And of course, I do the shows at Stockcharts on Thursdays, Wednesday evenings, or Thursday mornings. And so I wanted just to point out that on Friday, with the consumer sentiment coming out, we posted the second lowest reading we've ever seen on the University of Michigan consumer sentiment. And again, that's been coming out monthly since 1978. And this is the second lowest reading on record that we just got on Friday. Now, you might say, oh, wow, well, things are really getting bearish. I want to get out of the market. Before you do that, I want you to look at history and I want you to look at each time consumer sentiment drops back down into this range. I look at it like 65 is starting to get really bearish, but 50 obviously is extreme bearishness. But look at these times where we've gone to these lows. I've made it really easy for you. You've got the S&P 500 on top, got the University of Michigan consumer sentiment, the bottom panel, and I've got these green dotted vertical lines marking these lows below 65 and showing you where the S&P 500 was at each of these times. And you tell me how much more additional selling you see when the readings get this low. I mean, early 1980, that was the beginning of a 20-year secular bull market. 1982 was getting close. We did have one little period where we went back down. So everybody got bearish again right before the market took off in the 1980s. 1990, remember the Persian Gulf War? At the bottom, everybody was getting more and more bearish. Sentiment turned very negative. We got reading down below 65 just before we had a massive rally. Then we can fast forward all the way to the financial crisis. The one time, and I want to be honest and objective and point this out, the one time that we went down into the 50s, we did that back in first half of 2008. We did have a lot more selling to go. Then we reached down just about the same level again in November, and then again in March when we actually were closer at the bottom. So you can see two of these three came in at or near the bottom. Only one of them, and that's true of all of these signals, only one time in the last 50 years that we have seen a sentiment reading come in pretty bearish and still see the market fall significantly from that level. One time in 50 years. All the others marked pretty significant bottoms in the market or pretty close to significant bottoms. The other thing I want to point out, you might think, well, the market should do really well when everybody's, really bullish, when the sentiment is strong. Look at the highest reading we ever had on consumer sentiment. When did it hit? It hit at the beginning of year 2000 after a 20-year secular bull market advance right at the top before the dot-com bubble. In fact, we had no meaningful new all-time highs after that consumer sentiment reading for 13 years. These are contrarian indicators. When we see that things are just looking great, that's normally when we're going to start to potentially have some problems. And when everybody is bearish, that's generally when the market's going to rally. That's what you've got to be thinking. You can't go along with the crowd and the masses, or you're just going to lose money like the masses lose it. You have to be willing to go outside the box, call the market tops when we start seeing signs and rotation and negative divergences and complacency and all those things. That's where tops are born. Bottoms are born with fear and panic. A VIX that's in the 50s, an equity only put call ratio, which just jumped 5-day moving average, just jumped the highest level in 2025, with a University of Michigan consumer sentiment, the second worst reading on record. That's when you need to be thinking about buying. That's the way the market works. So again, I can't tell you where we're going here over the next couple weeks, couple months. I know there's still a lot of folks really nervous about the tariffs, what's going to happen, and there's been a lot of changes. Hey, I get it all. It's not like I'm oblivious to it. I've seen, here, we're going to set these tariffs. Nope, we're going to pull them back. Nope, now we're going to add to them. Oh, now we're going to pause. I mean, the uncertainty is obvious. And then you got the possibility of inflation, which I don't think is a possibility, but some do. And so they're still worried about that. They're worried about the economy. But look where the stock market is. We're not at the high anymore. Market's priced in a lot of this. And that's what you got to be thinking about is when everybody else finally recognizes that everything's bad, the market a lot of times has already priced it in and it will start looking 6 to 9 months down the road. And that's where I believe bottoms could form and how we could make a big rally back to the upside. So anyway, that's what I got for everybody this week. I'll be back next week. Who knows where the market will be, but I will be here to try and help walk you through some of this. Anyhow, everybody have a great rest of your week and weekend. Enjoy the long weekend. We are off on Friday this week. Market closed for Good Friday. So get some time. We'll get our pause of our own, 3-day pause of our own this weekend. Have a great rest of your week, everybody. Happy trading.